Students, we're moving on now to talk about accounting for stock options. Now, the difference between the stock units or shares that we talked about in Learning Objective 1 and options in Learning Objective 2 is that with options, you're not getting the share of stock for free. You're getting it at a certain price. So remember, you would only exercise an option if the stock was trading for more than the exercise price. So for example, if I worked for Amazon and they gave me options worth $5, that would mean I could pay them $5 and they would hand me back a share of stock. As long as that stock's trading for anything higher than $5, I'm making a profit. For example, if it's trading at $15, well, now I have the ability to sell a share for $15 that I only paid $5 to get. So stock options, again, can be a great tool for companies to incent employees to stay longer because the stock options tend to vest over, again, 1, 3, or 5 year periods. So exercise price, this is the amount that we've got to pay for the option. The options often expire long after they've vested. So for example, when I worked for Wachovia, I had stock options that had vested back in 2008 that didn't expire until 2018. So sometimes they can go on for quite a bit longer even after the vest date. So again, it's a form of compensation, which means we're going to have some type of expense associated with it. And the accounting tends to be pretty straightforward. When I grant it, I don't do any entries. The information may end up in the footnotes, the financial statements, but there's no entry because I've just granted an option. I haven't handed anybody or given them a share of stock. As it vests, I'm going to increase that compensation expense based on the fair value and increase paid-in capital. And then when people actually decide to exercise their stock option, they'll give me cash for whatever that option price was they're entitled to. And then I'll decrease the paid-in capital stock option account that I've been increasing over the vesting period, and the rest will just look like any normal issuance. Sometimes stock options expire and people don't use them. Why would that happen? Well, it happened to me with Wachovia. I had options, and I'm not going to get these numbers quite right, but for illustrative purposes, I had options where I could buy shares of stock at $40. However, the stock was only trading at $20. You would never give somebody $40 for something that they would give you back that was only worth $20. So again, there are a lot of options that were expired. So let's do a couple examples. Year 1, RAM awards a total of 100,000 stock options. So that means people can come in and acquire shares. Again, par, remember, that's meaningless. We just have to do bookkeeping there. What's meaningful is the exercise price and the fair value. Okay, so the 1,000 employees can purchase shares at $5 per share. That happens to be the same price, the market price on the date. That's important. Tends to be the way they work. There are models out there in the workplace that will value stock options using something usually called a Black-Scholes model. In this example, right, we're not in a higher math class. I'm just going to give you the fair values. So in this case, using a fair value option pricing model, management estimates the total compensation expense is $540,000. It's a 3-year vesting, so again, no entry at the time of grant, and I will take that $540,000 fair value divided by the number of years, and every year I'll increase compensation expense and I will increase that paid-in capital stock option account. The remaining 10,000, oops, I skipped a step. Employees exercised 90,000 of the options, so 90% of folks said, oh, I want to buy that, right? And on that date, the shares were trading at $7 per share. So think about what these employees are doing. They're giving up $5 and they're getting back a share that's worth $7. So what we will do is we'll show that $5 cash coming in. We're going to empty out whatever we've put into that paid-in capital stock options account. we had put in $540,000 over the 3 years, but I'm multiplying it by 90% because only 90% of folks are exercising right now. The rest of the entry just looks like it normally does whenever I issue stock. So I increase common stock, I increase the paid-in capital. Notice this, whatever the share is trading for when people exercise it, the company doesn't care, right? The only data points that were important to us is what people had to pay for it and the fair value at the beginning that we've been expensing over time. Okay, the people that care about what the stock price is trading, for are the employees, right? You can generate a lot of personal wealth if you manage your stock option awards prudently, right? Because this is usually if you're working for a company who's got some good growth, then you'll be able to exercise these options and hopefully can make a good bit. Now, the remaining 10,000 options, or 10%, were never exercised. Maybe the folks didn't have the $5. Maybe they weren't interested. Kind of weird since it was trading higher, but we'll go with it. Well, when it expires, we're just going to do a little bookkeeping inside the paid-in capital section. We're going to go ahead and take out the rest of that money we had put in there as we accrued it over time, and we will credit paid-in capital expired stock options. Notice we don't reverse compensation expense, right? We keep it equity neutral. We just bump it out of the stock options and put it down into the expired stock options. With E, we're going to assume the original scenario, except that 20,000 options were associated with employees who left the company in year 2. Okay, here's one, again, that I'm just not going to do justice to because I'm trying to talk and don't have a board in front of me. But it really comes down to you've got to pause at year 2 and say, all right, if 20,000 options, right, I don't have to worry about 20,000 options because they've left the company. I started out with how many options did I give out? I gave out 100,000. Okay, so roughly 20% of those options are gone. So what I've got to do is catch myself up and say, oh, wait, where should I be, right? So 20% of those options people have left. So the total compensation reflecting that forfeiture is the 540,000. Remember, that was the number we came up with at the beginning, right? That 540,000. We're going to multiply that times the 80%, because that's how many are still left. And we say, okay, that gives us 432,000. 432,000 is how much I need to have expensed over 2 years. How much have I expensed so far? Right? I've expensed so far in this example. Go back. The expense example 108. So because the 180 was expensed in year 1, we only need an additional, I think I said that backwards. Because the 108 was expensed in year 1, we need an additional 180. So again, I just feel like I'm just not saying this right, and I'm looking at the book while I'm doing it. So again, I'll do the extra one for this piece because the vesting, when people are walking away, gets a little confusing. Last thing before I come back, actually, you know what? I'll do these class pack ones separately with that too. Only 2 things you need to know about employee share purchase plans is whether they're large or small. So you don't record any compensation expense if it's offered at a discounted price, right? As long as each of these are met. Everybody's getting it. Nobody's getting anything more favorable. Any purchase discount isn't significant. Pretty much everybody can participate on an equitable basis, right? So if any of this condition is not met, we've got to record compensation expense. You'll see large companies do this. I remember at a company I worked for, the CEO gave everybody a very small employee share purchase plan discount because he wanted everybody to be able to sit for a refrigerator. It was just something really odd. My husband works at IBM. He can buy stock at a slightly discounted price. So again, no compensation expense. Let's look at an example. So we call those non-compensatory, right? So they can buy it at 95% of the fair value. That's considered small, right? Because it's a less than 5% discount. So we're simply going to receive the cash from our employees, multiply it times the number of shares, and we're giving them a discount, so it's only 95% of that number they have to give us, and then we issue the stock. If instead it was going to be larger, and we would consider it compensatory, right? Because notice it's a 10% discount right now. It exceeds the 5%. Now we've got to go ahead and take some compensation expense. So in this case, we'll do the amount of cash they give us. They're giving us 90%. The remaining amount then, up to 100% of the $18, has to go into compensation expense, and I issue my shares. So notice that what this impacts, if I compare it to the first entry, and granted these are different cash amounts because it's 90 versus 95, but in this first one there's no compensation, second one there is, and the difference between the two is the fact that we were offering it at greater than a 5% discount. Okay, look for one more video from me over the weekend that'll go through exactly how to do some of the updated assumptions with vesting.